Both start with the exact same amount of capital. Both have access to the exact same charts, the exact same news feeds, the exact same indicators. One of them even has a slightly better strategy on paper, a system with a proven backtest, a solid win rate, a clear set of rules. 6 months later, the trader with the better strategy has blown up his account. The other trader, using a simpler, less impressive system, has grown his account steadily. Same market, same tools, same starting point, completely different outcomes. What happened? The difference wasn't the strategy, it wasn't the indicators, it wasn't even luck, not really. The difference was what was happening inside their heads while the candles were moving on the screen. One trader was being controlled by his emotions without even realizing it. The other had learned, sometimes the hard way, how to observe his emotions without being ruled by them. This is the story of trading psychology, the silent force that decides, more than any strategy ever could, whether a trader survives or gets wiped out. If you have ever taken a perfect setup and still lost money, if you have ever watched a winning trade turn into a loser because you couldn't pull the trigger to close it, if you have ever revenge traded after a loss and dug yourself into a deeper hole, this is for you. Stay until the end, because by the time we're done, you will understand exactly why 90% of traders fail, and more importantly, what you need to do differently so you don't become another statistic. Let's begin. There's a saying among veteran traders that goes something like this: give a losing strategy to a disciplined trader and they will find a way to survive. Give a winning strategy to an undisciplined trader and they will find a way to lose. At first, this sounds like an exaggeration. Surely the strategy matters. Surely the edge, the mathematical advantage that makes a system profitable over hundreds of trades, is what separates winners from losers. And yes, an edge matters. You cannot trade psychology alone and expect to profit from a system that has no statistical advantage. But here is the uncomfortable truth that most beginners refuse to accept. Strategy is only half of the equation, and often the smaller half. Think about it logically. A trading strategy is simply a set of rules. Enter here, exit there, risk this much, take profit at this level. On paper, on a spreadsheet, in a backtest, these rules perform exactly as designed, because a spreadsheet does not feel fear when the price starts moving against it. A spreadsheet does not feel euphoria when it sees 3 winning trades in a row and starts increasing its position size out of overconfidence. A spreadsheet does not lie awake at 2 a.m. replaying a loss over and over, wondering what it did wrong. You do. You are not a spreadsheet. You are a human being with a nervous system that evolved over hundreds of thousands of years to keep you alive on the savannah, not to help you sit calmly while your account equity swings up and down on a screen. Your brain treats a red candle the same way it treats a rustle in the grass that might be a predator. It triggers the same fight or flight response. Except in trading, fight often means overtrading and revenge trading, and flight often means cutting winners too early or freezing when you should act. This is why 2 traders with identical strategies can have wildly different results. The strategy is the map. Psychology is the vehicle, the fuel, and the driver all combined. A perfect map is useless if the driver panics at every turn, or falls asleep at the wheel out of boredom, or floors the accelerator because he's angry after missing an exit. Professional traders, the ones that last for decades and not just a few lucky months, will tell you almost universally that psychology, risk management, and discipline account for the overwhelming majority of long-term success. The strategy gets you in the game. Your mind determines whether you stay in it. So before we talk about candlesticks, moving averages, or support and resistance, we need to talk about the 6 inches between your ears. That is where trading is actually won or lost. Part 2. The fear that freezes and the fear that destroys. Let's talk about fear first, because fear is usually the first emotion a new trader meets, and it wears several masks. Fear of missing out, FOMO. The first mask is FOMO, the fear of missing out. You're watching a chart, the price starts moving fast, a strong green candle, then another, then another. You didn't get in at the start because you hesitated, or because you were away from your screen, or because you were waiting for a better entry. Now the move is already underway, and every fiber of your being is screaming that if you don't jump in right now, you're going to miss the opportunity of the week. So you buy, not because your strategy told you to, not because there was a valid setup. You buy because you are afraid of missing out on profit that other people, imaginary people, faceless people on the internet, are supposedly making right now while you sit on the sidelines. And what happens next, more often than not, the move you jumped into late is already exhausted. The smart money that started the move is now taking profit right into the wave of latecomers like you. The price reverses, and now a second emotion kicks in, the fear of being wrong, which often turns into hope. It'll come back, you tell yourself. It often doesn't, not before your stop loss, if you even set one, gets hit. FOMO is fear disguised as excitement. It feels like opportunity, but it behaves like a trap because it removes your process and replaces it with pure emotional reaction to price movement you did not plan for. Fear of losing. The second mask of fear is more direct, the fear of losing money. This one shows up in a strange, almost paradoxical way. You take a trade, your setup is exactly what your strategy calls for, and the moment you enter, your body tenses. Your eyes are glued to the screen. Every tick against you feels like a physical blow. And so, the instant the trade shows even the smallest hint of profit, you close it. Not because your plan told you to take profit there, not because the target was reached. You closed it because the fear of watching a winner turn into a loser was unbearable. So you took whatever gain was available just to make the discomfort stop. This is one of the most common and most destructive patterns in all of trading. Cutting winners short, while ironically, the same trader often lets losers run far longer than they should, hoping the market will turn around and save them from having to accept the loss. It is the exact opposite of the golden rule of trading. Cut your losses short, let your winners run. And it is driven entirely by fear, not by strategy. Fear of being wrong. There's a third layer here, subtler than the first two, the fear of being wrong. Many traders, especially those who are intelligent, successful in other areas of life, or simply proud, struggle enormously with admitting a trade idea was incorrect. Their ego gets tied to the trade. Closing the losing trade at a loss doesn't just feel like losing money, it feels like admitting personal failure, like losing an argument, like being proven stupid. So, instead of closing the losing trade at the predetermined stop loss, they move the stop loss further away. Just a little more room, they tell themselves. The market will turn around. Sometimes it does, and this reinforces exactly the behavior that will eventually destroy the account. Because the one time it doesn't turn around, the loss is catastrophic, large enough to wipe out weeks or months of careful gains in a single trade. This is how fear, in its various disguises, becomes one of the two great forces that ruin traders. But fear has an equally destructive twin. Part 3. Greed, the quiet accelerant. If fear is the force that makes traders freeze, hesitate and cut winners short, greed is the force that makes them push too far, take too much risk, and refuse to stop even when every signal says they should. Greed rarely announces itself honestly. Nobody wakes up and says, "Today I will be greedy and destroy my account." Instead, greed disguises itself as confidence, as opportunity, as ambition. It sounds like this: "I'm on a hot streak. I should increase my position size." It sounds like, "This setup is so obvious. I should risk more than usual." It sounds like, "I've already made my daily target, but the market is still moving. Why would I stop now?" The overconfidence trap. Here is a pattern that has destroyed more trading accounts than almost any other single behavior: a string of winning trades. It sounds strange, winning trades causing destruction, but consider what happens psychologically after 3, 4, 5 consecutive wins. The trader begins to feel invincible. The brain, which is constantly looking for patterns, starts to believe that it has figured out the market. Confidence turns into overconfidence. Overconfidence leads to bigger position sizes, looser risk management, trades taken outside the strategy because I have a good feeling about this one. And then the market, which owes no one anything and follows no one's feelings, does what markets do. It reverts, it surprises, it punishes complacency. The trader who was risking 1% per trade during the winning streak is suddenly risking 5%, 10%, because I'm on fire right now. One bad trade at that size can erase days or weeks of gains in minutes. This is why professional risk managers and truly experienced traders treat winning streaks with just as much caution as losing streaks, sometimes more. A losing streak makes most traders cautious, almost too cautious. A winning streak makes most traders reckless, and recklessness is far more dangerous because it feels good while it's happening. The refusal to take profit. Greed also shows up as an inability to take profit at a reasonable, pre-planned target. The trade hits the target. According to the plan, this is where you close some or all of the position. But greed whispers, "Why stop here? It could keep going. I could make so much more." So the trader holds. Sometimes the market does keep going, and greed is rewarded, which is precisely the problem. It gets reinforced. But often, especially at extended price levels, the market reverses, and the trader watches unrealized profits shrink and shrink and shrink until the winning trade turns into a losing one, or at best into a much smaller win than what was originally on the table. Revenge trading. Perhaps the most dangerous combination of fear and greed together is what traders call revenge trading. It usually starts with a loss, sometimes a normal, expected loss that's part of any strategy, sometimes a larger loss caused by a mistake. Instead of accepting the loss and stepping back, the trader feels a surge of anger, frustration, and an urgent need to win it back immediately. The very next setup, even a mediocre one, gets taken, often with a larger position size than usual because the goal has shifted from "follow my strategy" to "make back what I just lost right now." Revenge trading is greed wearing the mask of urgency, fueled by the emotional pain of loss. It is, without exaggeration, one of the single fastest ways to blow up a trading account, because it strips away every rule, every ounce of discipline, and every bit of patience that the trader may have built over months. A single revenge trading session, born from 20 minutes of anger after one bad trade, can undo 6 months of careful, disciplined growth. Fear and greed are the two engines that drive almost every psychological mistake in trading. But understanding them intellectually is only step one. The real work is in building systems and habits that protect you from them even in the heat of the moment, when your rational brain is least in control. That's what we'll cover next. Part 4. The illusion of control and the need to be right. Before we move into solutions, there's one more psychological trap worth exploring deeply because it's subtle and it affects even experienced traders: the illusion of control and its close cousin, the need to always be right. Markets are probabilistic. No strategy, no matter how good, wins 100% of the time. Even the best professional traders in the world, the ones running hedge funds with teams of analysts and decades of experience, lose on a significant percentage of their trades. What separates them from beginners isn't a higher win rate necessarily, it's how they manage the trades that go wrong and how they think about probability rather than certainty. New traders, however, approach the market wanting certainty. They want to be right. Each trade feels like a personal test, a verdict on their intelligence or skill. This creates a dangerous psychological trap. When a trade goes against them, instead of seeing it as one probabilistic outcome among many, they see it as a personal failure that must be corrected immediately or hidden or fought against. This is why so many traders will not use stop losses, or will remove them once the price approaches, or will average down into a losing position again and again, adding more and more money to a trade that the market has already told them is wrong. Each of these behaviors comes from the same root: an inability to separate self-worth from trading outcomes, and a refusal to accept that being wrong on any individual trade is not just possible, but expected and completely normal. The traders that last are the ones who make peace with uncertainty. They stop asking, "Will this trade win?" and start asking, "Am I following my process?" They understand that a loss taken according to plan is not a failure, it's simply the cost of doing business, the same way a shop owner accepts the cost of rent, or a farmer accepts that not every seed will grow. A win taken outside the plan, through luck, is not a success either. It's a dangerous reinforcement of bad behavior that will eventually catch up with them. This shift, from needing to be right to needing to be disciplined, is one of the most important mental transformations a trader can make. It usually doesn't happen through reading a book or watching a video once. It happens slowly, through experience, through losses that hurt enough to force reflection, and through the deliberate building of new habits. Let's talk about what those habits actually look like. Part 5. Building the Disciplined Trader: Practical Foundations. Understanding fear, greed, and ego intellectually is necessary, but it is not sufficient. Knowledge alone does not change behavior under pressure. What changes behavior is structure, systems built in advance during calm moments that protect you during the emotional moments when your judgment is least trustworthy. 1. A written trading plan. The single most protective tool against emotional decision-making is a written trading plan created before you ever open a chart to look for a trade. This plan should define in specific and unambiguous terms what setups you are allowed to trade, what conditions must be present before entry, exactly where your stop loss goes, exactly where your take profit or scaling out levels are, how much of your account you are willing to risk on any single trade, and how many trades you are allowed to take in a single day or week. The power of a written plan is that it moves decisions out of the heat of the moment and into a calm, rational state of mind ahead of time. When the market is moving fast and your heart rate is up, you are not a reliable decision maker. But if the decision was already made yesterday in a calm state, all you have to do in the moment is execute, not decide. This dramatically reduces the emotional load of trading. 2. Position sizing and risk per trade. Nothing protects a trader's psychology more directly than proper position sizing. Here's why. If you risk an amount of money on a trade that, if lost, would genuinely hurt you, financially or emotionally, your brain will not be able to think clearly while that trade is open. You will watch every tick. You will feel your pulse rise. You will be tempted to close early out of fear or to move your stop loss out of desperation. But if you risk a small, predetermined percentage of your account, Many professional traders use somewhere around 0.5% to 1% per trade. A single loss becomes a non-event. It stings a little, but it doesn't threaten your account, your rent money, or your peace of mind. When the amount at risk is appropriately small, it becomes far easier to follow your plan with a clear head because there is nothing at stake emotionally beyond the trade itself. This is one of the most underrated psychological tools in trading. Proper position sizing isn't just risk management, it's emotional management. It is, in a very real sense, the foundation upon which good trading psychology is built. You cannot think clearly with your rent money on the line. You can think clearly when the loss, if it happens, is a rounding error in your monthly results. The trading journal. If the trading plan tells you what to do before the trading journal tells you what actually happened after the trade, and, more importantly, why. A serious trading journal records not just entry price, exit price, and profit or loss, but the emotional state of the trader at the time of entry and exit. Were you calm? Were you anxious? Did you deviate from the plan? If so, why? Over weeks and months, patterns emerge from a journal that are almost impossible to see in the moment. A trader might discover that most of their losses happen on trades taken after 2 p.m. when fatigue sets in, or that they consistently move their stop loss on trades involving a particular currency pair or stock because of some unconscious bias, or that their best trades, statistically, come from a specific setup they almost never trade because it feels boring. The journal turns vague feelings of frustration, like "I keep losing money," into specific, actionable data, like "I lose money specifically when I trade after a loss within the same session using a larger position size than my plan allows." You cannot fix what you cannot see, and the journal is the tool that makes the invisible patterns of your own behavior visible. 4. Predefined rules for bad days. Every trader has bad days, days where 2 or 3 losses in a row start to chip away at emotional stability. The disciplined trader has decided in advance what happens on a bad day. Common rules include: after 2 consecutive losses, stop trading for the day. After a loss exceeding a certain percentage of the account, take a mandatory 24-hour break. Never increase position size after a loss, only after a string of wins that still fall within the plan's guidelines, and even then, cautiously. These rules exist precisely because in the moment, emotion will always argue against them. The angry trader after a loss will always want just one more trade to fix things. The rule, decided calmly in advance, is what stops that impulse from taking control. 5. Process goals, not outcome goals. One of the most freeing psychological shifts a trader can make is to stop measuring success purely by profit and loss on any single day, and start measuring success by adherence to process. Did you follow your entry rules? Did you respect your stop loss? Did you avoid revenge trading? Did you stick to your position sizing? A trader who takes 5 perfectly executed trades according to plan and loses money on 3 of them due to normal market randomness has had a successful day, because the process was sound, and over a large enough sample of trades, a sound process with a real statistical edge will produce profit. A trader who makes money on a single day by abandoning their plan, taking oversized risk, and getting lucky has had an unsuccessful day, even though the account balance went up, because that behavior, repeated, will eventually destroy the account. This reframe, from needing to be right to needing to be disciplined, is difficult because our culture and our own instincts push us to judge everything by immediate results. But trading, more than almost any other pursuit, rewards those who can delay that judgment and trust a well-tested process over a long series of trades rather than reacting emotionally to each individual result. Part 6. The role of physical and mental state. Trading psychology is not purely abstract or purely mental. It is deeply connected to physical state, And this connection is often ignored by traders who focus exclusively on charts and strategy. Sleep deprivation dramatically impairs impulse control and risk assessment. This is well established in behavioral research generally, not just in trading. A trader who slept 4 hours the night before is far more likely to make impulsive, emotionally driven decisions than one who is well rested. The same is true of hunger, of stress carried over from other parts of life, of alcohol from the night before, of caffeine overload causing jittery, anxious decision-making. Experienced traders often develop pre-trading rituals, not out of superstition, but because these rituals put them into a calm, focused state before they risk real money. This might include a short walk, a few minutes of quiet breathing, a review of the trading plan and the day's key levels, or simply a firm mental commitment. Today, I follow my rules no matter what the market does. It's also worth naming something honestly. Trading can be genuinely stressful, and for some people, the ups and downs of watching money move in real time can take a real toll on mood and anxiety over time. If trading is affecting your sleep, your relationships, or your overall sense of well-being in a way that feels bigger than normal frustration with a tough market, that's worth paying attention to and talking through with someone you trust or a professional, rather than pushing through it alone. There's no shame in that. Protecting your mind is part of protecting your capital. Part 7. The stages of a trader's psychological journey. Almost every trader who has been in the markets for years will recognize a familiar arc, even though the exact timeline differs from person to person. Stage 1. Unconscious incompetence. The beginner enters the market with excitement, often after seeing others post screenshots of gains online. They don't yet know what they don't know. Early wins, if they happen, are attributed to skill rather than luck, which sets up dangerous overconfidence. Stage 2. Conscious incompetence. Reality sets in. Losses accumulate. The beginner realizes trading is much harder than it looked and starts to understand that they lack both strategy and discipline. This stage is often accompanied by frustration, self-doubt, and for many, the temptation to quit entirely, or worse, to chase increasingly risky strategies hoping for a shortcut. Stage 3. Conscious competence. The trader who pushes through Stage 2 begins to build real skill, but it requires constant, deliberate effort. They have a plan and can follow it, but it takes visible willpower and concentration to do so. Every trade still requires active mental effort to avoid emotional mistakes. Stage 4. Unconscious competence. With enough time, enough journaling, enough repetition, discipline becomes second nature. The trader doesn't have to fight the urge to revenge trade. The thought barely arises because good habits have replaced the old emotional patterns. This is where consistent, sustainable profitability tends to live, and it is usually the product of years, not weeks, of deliberate practice. Understanding this arc matters because it helps set realistic expectations. If you are currently in Stage 2, frustrated and losing money, this doesn't mean you're incapable of becoming a good trader. It means you're exactly where almost everyone who eventually succeeds has been. The traders who make it through are not the ones who never struggle. They're the ones who keep refining their process and their psychology instead of quitting or doubling down on reckless behavior. Part 8. Common psychological traps revisited with solutions. Let's bring this together into a practical trap-by-trap breakdown. Trap: FOMO entries. Solution: create a strict rule that you only enter a trade if it meets your written setup criteria at the moment you see it. Never chase a move that has already run significantly without a fresh, valid entry signal. If you miss it, you miss it. There will always be another setup. Trap: cutting winners too early out of fear. Solution: use predetermined take-profit levels or a trailing stop system decided before the trade, removing the in-the-moment decision entirely. Consider scaling out, taking partial profit at a first target while letting a portion run, which can reduce the emotional pressure of watching an entire position. Trap: moving stop losses further away. Solution:
Set the stop loss at the same time you enter the trade and treat moving it as a broken rule requiring a journal entry and reflection, not a normal adjustment. Some traders use broker features that lock in a stop loss for a set period to remove the temptation entirely. Trap: revenge trading after a loss. Solution: implement a hard rule. After any loss, a mandatory pause of at least 15 to 30 minutes before considering another trade, and after 2 losses, no more trading for the day. Trap: overconfidence after a win. Solution: cap position size increases to a slow, rules-based schedule rather than an emotional one. For example, only increasing size after a full month of consistent plan-following results, not after 3 good days in a row. Trap: refusing to accept being wrong. Solution: reframe every loss in your journal as the cost of running my process, the same way a business owner records the cost of goods sold. This linguistic and mental shift, repeated consistently, slowly detaches identity and self-worth from any single trade outcome. Trap: trading to escape boredom. Solution: recognize that the urge to trade just to do something when no valid setup exists is itself a psychological signal, not a market signal. Some traders literally write "no valid setup, do not trade" on a sticky note next to their screen for exactly this reason. Part 9. A real-world scenario, walked through step by step. Let's walk through a realistic scenario to see all of this in action. Imagine a trader that the story will call The Trader to keep it general and relatable. It's a Tuesday morning. The trader has a written plan: risk 1% per trade, only take setups matching a specific chart pattern, maximum 3 trades per day, mandatory break after 2 losses. The first trade of the day is a clean setup. The trader enters exactly according to plan, sets a stop loss and take profit immediately, and steps away from the screen rather than staring at every tick, because the plan doesn't require constant monitoring. 30 minutes later, the trade hits the stop loss, a normal, planned loss, 1% of the account. The trader logs it in the journal. Valid setup, followed plan exactly, market simply went the other way. No emotional deviation. This is, importantly, still a successful trade from a process standpoint, even though it lost money. Now here is where psychology becomes critical. Without a plan, the natural human reaction after a loss is often to feel a pull toward getting it back. The trader recognizes this pull, a slight tension, a temptation to lower the standards for the next setup just to get back into the market quickly. But because this reaction was anticipated in advance, the trader recognizes it for what it is, an emotional impulse, not a market signal. Instead of acting on it, the trader takes the mandatory short break, has a glass of water, and reviews the plan again. A second setup appears an hour later. It's a good one, matching all the criteria. The trader takes it, same process, same discipline. This one hits the take profit target, a 2% gain, following the plan's typical risk-to-reward ratio. Immediately after, there's a pull in the opposite direction now. Excitement, a feeling of, I'm on a roll, maybe I should take a slightly bigger position on the next trade to make even more money. This too is recognized as an emotional impulse rather than a rational, plan-based decision, and it is set aside. By the end of the day, the trader has taken 2 trades, 1 loss and 1 win, ending the day roughly flat to slightly positive, having followed the plan with discipline throughout. From the outside, this looks unremarkable. No exciting story of a huge win, no dramatic loss either. But this is exactly what sustainable, professional trading looks like day after day. Unremarkable, disciplined, process-driven decision-making, repeated consistently enough that a real statistical edge has room to play out over hundreds of trades. Contrast this with a second version of the same day. The trader takes the same first loss, but instead of pausing, immediately jumps into a lower quality setup, doubling the position size to make it back faster. That trade also loses. Now frustrated, the trader takes a third trade, technically violating the daily maximum, on a setup that doesn't really meet the criteria, sized even larger out of mounting desperation. This one loses too. In a single emotionally driven hour, a trader who might have ended the day flat has instead lost 5 or 6% of the account, not because the market was unusually difficult, but because psychology, unchecked, took over the decision-making process entirely. Same market, same day, same starting setups, wildly different outcomes, driven entirely by what was happening in the trader's mind after that very first, completely normal loss.
Part 10. Long-term mindset, patience, consistency, and humility. We've covered a lot of specific traps and specific tools, but underneath all of it lies a broader mindset shift that separates traders who last from traders who eventually flame out, no matter how talented they seemed at the start. Patience. Trading rewards those who can wait. Wait for the right setup. Wait for a trade to play out according to plan without interference. Wait through losing streaks that are a statistically normal part of any strategy. Wait months or years for genuine skill to compound. Impatience is often the hidden root cause behind FOMO, revenge trading, and oversized positions. Cultivating patience deliberately as a practiced skill, not something you either have or don't, pays dividends across every other part of trading psychology. Consistency. The trader who follows a mediocre plan with perfect consistency will over time almost always outperform the trader who follows an excellent plan inconsistently. This is counterintuitive to beginners who spend enormous energy searching for the perfect strategy, when in reality most reasonably sound strategies executed consistently will produce a positive statistical outcome over enough trades. Consistency of execution matters more than the marginal quality of the strategy itself. Humility. The market does not care about your opinion, your prediction, your analysis, or your feelings. It will do what it does, regardless of how confident you are. Humble traders hold their opinions loosely, are quick to admit when a trade isn't working, and never stop learning because they understand that no matter how many years of experience they accumulate, the market can still surprise them. Arrogant traders, by contrast, tend to dig in when wrong, refuse to adapt, and eventually get run over by a market that has no interest in their ego. Self-compassion without self-indulgence. There's a difficult balance here worth naming directly. On one hand, harsh self-criticism after every loss is corrosive and eventually leads to burnout, anxiety, or abandoning trading altogether out of frustration. On the other hand, excusing every mistake without honest reflection prevents growth entirely. The healthiest traders learn to separate the two questions clearly. Did I follow my process? And what is the outcome? A loss with a followed process deserves no self-blame at all. It's simply the cost of doing business. A loss caused by a broken rule deserves honest, unemotional reflection in the journal, followed by a concrete plan to prevent it next time. Not shame, just correction. Part 11. What to do starting today. Let's turn all of this into something you can actually act on, starting with your very next trading session. First, if you don't already have one, write down your trading plan today in plain language, covering your setups, your entry rules, your stop-loss placement, your position sizing, and your daily trade limits. Keep it short enough that you could recite the core rules from memory. Second, start a trading journal if you don't already have one, and commit to logging not just the numbers of each trade, but your emotional state before, during, and after. Review it weekly, looking specifically for patterns, times of day, specific setups, or specific emotional states that correlate with your best and worst results. Third, set your position sizing so that a single loss genuinely does not disturb your peace of mind.
If you find yourself checking a trade obsessively or feeling physically tense while it's open, that is direct feedback that your position size is too large relative to your emotional tolerance, regardless of what the textbook percentage says. Fourth, build in mandatory pauses after losses, after wins, after any deviation from plan, and treat these pauses as non-negotiable, the same way you would treat any other safety rule. Fifth, shift your daily definition of success away from profit and loss alone and toward process adherence. At the end of each session, ask yourself honestly, did I follow my plan? That question, asked consistently and answered honestly, will do more for your long-term results than almost any indicator or strategy tweak you could make. And finally, be patient with yourself. Mastering trading psychology is not a weekend project. It is a skill built through repetition, through mistakes, through honest reflection over months and years, the same way any other high-stakes skill is built. The traders who eventually succeed are rarely the ones who never struggled. They're the ones who kept refining their relationship with fear, greed, and their own mind, one trade, one journal entry, one disciplined decision at a time. Conclusion. At the very beginning, we talked about two traders with identical strategies and completely different outcomes. By now, it should be clear why. The market is, in many ways, a mirror. It reflects back your discipline, your patience, your ability to sit with uncertainty, and your willingness to follow a plan even when every emotional impulse is screaming at you to do otherwise. It has very little interest in how clever your strategy looks on paper, and a great deal of interest in whether you can execute that strategy consistently, trade after trade, through both winning and losing streaks, without letting fear or greed hijack the process. This is genuinely hard. It's supposed to be hard. If it were easy, everyone would do it successfully, and the very inefficiency that creates trading opportunity in the first place would disappear. But hard doesn't mean impossible. Every trader who has gone on to trade profitably and sustainably over the long term has walked through the same fears, the same greed, the same painful losses, and the same difficult lessons that you might be facing right now. The strategy will get you started. Your mind, trained deliberately and honestly over time, is what will keep you in the game long enough to see that strategy actually work. Master that, and everything else becomes far more achievable than it looks from where you're standing today. Thank you for watching. If this gave you a new way of thinking about your own trading, take a moment right now to write down just one rule you're going to commit to for your very next trading session. That one small commitment, followed consistently, is where real change actually begins.